Welcome to Dave and Don Demystify, a FinTech Futures podcast, helping make sense of the world of FinTech and digital finance. Please sit back and listen as the two Ds take a subject and discuss it to make it clearer and easier to understand.
Demystify.
Welcome everybody to the Dave and Don Demystify show, and this week we're going to demystify digital banking transformation. And to help me to do that, and Dave obviously, are two giants from the core banking space. And I have to say, this is the first time I'm actually speaking to them both together, because normally I'd speak to them individually. So it's a great pleasure to welcome these two giants. I'm Don Free, who was previously the lead analyst at Gartner, and Jost Hoppermann, who was previously the lead analyst at Forrester. Welcome, guys.
Hey, thank you very much.
Thank you.
Look, it's a great pleasure to have you guys on the show. There may be an odd person that doesn't know who you are, but could you each give a bit of background on yourself and just explain what you're doing now?
My name is Don Free. I spent a ton of time in the banking industry. It used to be almost equal parts between vendor and I would say analyst within Gartner, but I'm probably a little more lopsided to Gartner now, but a little bit less than 24 years. But my actions today kind of take me in a different direction than my past, which is on my own. I've become independent, and I'm trying to have some fun in the remaining years just to keep driving on my passion, which is, say, bank transformation, core banking, and all the fun stuff that surrounds that.
Fantastic.
So in my case, my name is Jost Hoppermann, and obviously there are many ways to pronounce my first name, so don't bother to find the right one. But at the same point in time, I used to be in the banking industry from a variety of perspectives for a very long time, very similar to Don. I guess I left Forrester after roughly 23, 24-ish years. And today I'm also an independent analyst, focusing not only on core banking transformation. I also continue to work on topics that I like to work on in the past, like experiences, engagement solutions, and also the architecture to support transformation. And obviously before I had a history as well, so I had plenty of roles in banking. Before I became an analyst, I was the head of architecture of a larger European bank and a couple of other roles. And I guess what is important to mention as well, since we said we would also like to talk a little bit about today, is not only about Don and me working on various flavors of banking software and banking transformation. In our little team that we call the Angry Rabbit Group, you can see a gentleman behind me. We also have Ellen Carney, and she is not in the call today because she is focusing mostly on the insurance side of the house.
Fantastic. I have to say, it does look like a very angry rabbit. So fantastic. We're sort of many years into this sort of digital transformation of the sector. And I just wanted to get your perspective on it. Are we done? Institutions must have spent a fortune on transformation so far. And where are they at? I mean, it'd be kind of good to get your perspective on that. I mean, Don, what's the view from the North American perspective?
Yeah, well, if you want me succinct, I would say in a word, no. But this is human behavior. We try to place finite boundaries on change. But if you look at this practically, once and done doesn't apply to digital transformation. It's a moving target. So if I want to answer this question a little bit more than succinctly, as I was saying before, I would say that I have to examine the banking market through a lot of different lenses, tiers, segments, geography. But since we have somewhat limited time today, I'm going to focus on banking tier sizes because I think that helps most try to understand where things are. So if I think about the tiers, I'll kind of go through this in a basically 1 through 5, where 1 represents the large national or multinational banks, and 5 represents kind of the smaller local banks. For those probably tier 3, tier 5 banks where budgets are pretty tight, there's a big reliance on software vendors to shoulder their transformation needs. And they typically do this through release upgrades. That's been the chosen path. But the thing is with these banks, if they choose the wrong vendor, it's basically a 7 to 10 year prison sentence with that single vendor, and you're stuck. For those that are in this kind of higher end bank, for maybe tier 1, tier 2, their big challenge is complexity and overlapping tech. So their transformation is relegated to really tech chunks that are aligned to the business domains. So I think, to sum it up, if you look at this from a North American perspective, there's a lot of activity still going on, and I anticipate that will continue over the years.
When we look at Europe or the larger European picture, I guess we certainly also need to look at tiers. At the same time, I do not want to repeat everything that Don has said, so let me add a few additional perspectives. When it comes to the tier ones and maybe also the tier twos in Europe, you're certainly seeing that they are investing heavily, as Dharmesh rightly said, but at the same point in time, it's not necessarily the investment in the right spaces. So if a bank is heavily focused on custom build, for example, they may prefer to go for a so-called off-the-shelf solution that needs a lot of custom development, because this is basically the basic mentality. Is this a good path, a quick path, a fast path to transformation, to a successful transformation? This is certainly a question that we can discuss for more than 30 or 50 minutes. At the same time, when we look at some other companies, they have successfully worked with 1 or 2 or 3 selected off-the-shelf vendors, adding some bits and pieces, and they are fine today. However, when it comes to the smaller banks, I do not want to say it's tier 3 or tier 4, but let's say for smaller banks, we certainly have a different situation in Europe. In many countries, we have a situation where the smaller banks work mostly with captive service providers. Let's use my term here, which basically means they're working with software providers that are owned by these smaller banks. There are examples in the loan and savings sector in many countries. There are examples in the corporate finance sector in many countries. Consequently, there is some kind of historic bound that goes even longer than the 7 years that Don mentioned. There are basically bounds that are, in some cases, 30, 40, 50 years old. And here we are certainly seeing a strong dependency on these captive service providers or captive revenue service providers, if you say so. The small banks are not, let's say, on their own powerful enough, maybe not knowledgeable enough to drive transformation. And the service providers have to look at cost, because this is certainly also a major concern of the smaller banks. And the outcome can be, I'm just thinking about a real life example here, that the service provider has just decided to plan their transformation starting in 2026, which is probably not truly early. And they also consider COBOL still as something that is a valid technology to extend business capabilities on the core. The good news is they decided that PL1, in my example, that PL1 has become legacy. So you can see there we are not necessarily talking about the latest technologies when it comes to core banking. At the same time, in the environment of those core systems, there are certainly modern technologies, because these banks certainly need to serve their customers in a way that is quite way more flexible. And what is probably also very important here is that some banks are very slow in transformation. And this is probably something we can look at from a different perspective when we also talk about more than just the state of the industry.
Fantastic. I mean, just to echo Dave's opener, which was, I've known you guys since about 2010, I think, or 2012. And from the outset, we've been talking about digital banking transformation. So it's been well over a decade for some of these banks. I mean, when it comes to transformation, what's the big lie about transformation that you guys feel that exists in the industry?
I can give it a start. So I'll give the easy answer. It's the we're done mindset. But if you look under the covers, there's a lot going on. One of the things that I look at and have been for many years is really the threat of composability. And that has many tech vendors running for cover. Things just don't work the same, especially within particular markets. So as you might imagine, anytime there are consolidation trends in the markets like the North America, tech vendors tend to lean back a little bit. They innovate less because there's really fewer competitive pressures to associate with that. So I don't have to work as hard. But the evolution of composability is disrupting this type of software stagnation. I believe it's going to promise to benefit the lower banking tiers as well as the larger tier banks. For the larger tier banks, it provides much more of a specific, really planning horizon to transform more effectively. So that's probably the big lie is like, we're done.
And I guess looking at composability, it's also very important to keep in mind that those vendors that focus to some extent on the European market, but also others certainly, promise a lot when it comes to composability. But in real life, even if we look at all these emerging specifications and 15 or 20-year-long efforts to standardize banking APIs and whatever, but if we look at composability, I guess it's fair to say that we can get, to some extent at least, composability within the portfolio of a given vendor. But as soon as we are looking at different portfolios, if we are looking at the combination of homegrown legacy and a modern vendor application, I guess composability will become something that we may see in the future, but that has not yet fully reached reality. So it's probably more future promise than a really existing capability to a full extent. That's one thing. The other thing is referring to what Don had said as transformation has not yet come to an end. I believe that to some extent, this is strongly related, not so much to technology, but to the mindsets of relevant executives. So to some extent, it's not interesting for say, for a CIO or for a similar role to start a transformation initiative, because typically the benefits of transformation will become real after the tenure of that CIO has come to an end. So benefit after leaving the company, the bank, risk before leaving the bank. So not a good balance for a given CIO. Then we are seeing CIOs that, or other leading executives that basically tend to focus on certain pet projects. They don't look at the transformation in general to identify the right steps, the right sequence, the multi-year process that a bank will typically run through that most likely will never come to an end. They're focusing on, say, just to make something up, an engagement platform because it's nice and shiny, process orchestration, and maybe, say, a limit system that is really great and really fancy and delivers new business value. But the rest of the architecture, the rest of the application landscape will typically remain in a slightly polished, maybe enhanced shape, maybe with new APIs, whatever, but it's not the overall transformation that a bank would need. If you put this together, 3 pet projects of CIO A in 10 or 4 or 5 years, then another sequence of pet projects, we are basically seeing that this kind of transformation will not bring us a more flexible, a more powerful application landscape, but probably an increased type of fragmentation just with more modern technologies.
It's interesting because I'm fascinated by capabilities as well. So I think about when Dharmesh and I first got together, like we did some projects for various banks to put them online. So this is going back to the late 90s. And if you think about the problem you had then, it was like, we need to get this thing online, one channel. I mean, Dharmesh, it's fair to say we probably worked in a cupboard under the stairs as well, didn't we? Because it wasn't a sort of strategic channel. But actually what we had to do was relatively ring-fenced. And now what you have, like you talk about composability and there's some other things which are coming in. The difference between transformation 30 years ago and now is enormous. What I was kind of keen to understand is what are some of the things that you think are really lacking now? So is the industry sort of behind the pace in terms of what the technology kind of offers? What are some of the things that you would be saying to banks? You really need to think about this from a kind of capability point of view, because things seem to suddenly be moving at such a fast pace. Like I can't keep up with everything at the moment. It's almost impossible. So there must be capabilities which are kind of missing.
I'll continue to go first. I'll elbow my way to the front. So to answer this question, I would say, again, the short answer is complexity and I would say compatibility for those two things. Those are the primary issues. If you look at this from a bank perspective, they want choice. they've been given this promise, rightly or wrongly, in the form of this future state of composability where they can plug and play, that old adage that we can kind of pull something in and just use it. And then when we get tired of it, we'll replace it with something else or something better or something bigger. I think those kinds of desires are impacting a lot of the vendors in the way they go to market. So you're kind of talking about limited budgets. When you have to be more things to more different types of consumers being banks, then you have to have your application design such that you can cater to those requirements. Smaller banks want bank in a box. Good. If you could deliver that while simultaneously being able to broaden your segmentation, your audience, your consumers to the larger tier banks that don't want everything that you have, and that in some cases would have to actually subtract some differentiating capabilities of their systems to be able to surrender to this broader swath of capability that you bring to the table, then I think you have to have this kind of view that compatibility is important. So I think for me, this speaks to, if you really start getting to the technology of this, it's building down systems into those kind of digestible chunks that are probably most marketable. It doesn't mean that create an API or a microservice for everything that you have. We saw that back in 2010 when the whole microservice trend was there, where breaking everything apart into its smallest possible components for everything, it just wasn't practical. That makes it a lot more complex to deploy and certainly to maintain. So that whole, I'd say, pendulum swing has gone back to, let's get what we need to have in an operational or functional capability, typically among a business domain. Not if you think of this in terms of organizations now that are trying to kind of coordinate this, think of buy-in and trying to get this down into something that does make some level of sense for the bank relative to its own construct. So organizing technology to accommodate the requirements of a bank requires you to kind of think about things in a more domain-based way. How do you do that with the technology? Well, I think I'm going to give my friend Jost a little bit of airtime here to explain some of the things we've been looking into and maybe upcoming to a theater near you.
All right, let me try at least. But before I do so, I guess we also have to add one additional perspective, maybe two, to the vendor side. Just to be fair, there's quite a number of vendors tried to offer the right size to microservices between 2010 and today. However, the consumption in the industry was not as expected. So they noticed that they couldn't invest too much because it would basically endanger their revenue streams. So today, vendors are trying to find a way to navigate between a cost-effective design and a right-sized or a set of right-sized microservices that are truly purchased by their customers. So, and that can fit into the application landscape. Another thing is certainly that some vendors have quite fragmented product management organizations that also do not create a foundation that Don mentioned, a tier one bank in a box, if I remember correctly, that they could basically assemble a well-suited application from their portfolio. So I know vendors that have a bank in a box application and a completely different code set for a tier one core. Obviously, this is nothing that is sustainable in the long term. If it would be some kind of, let's say, metrics type product design, it would be much smoother. But let's go back to the application piece. I think we talked about components, about capabilities, and I think what is lacking in banks today is to think about architecture in a way that is more independent of technology. If we have a piece of architecture that is focusing on integration, we do not necessarily, at least not in the first step, need to talk about technology. There are multiple technologies typically that can help us to integrate different bits and pieces of our application landscape. And this is exactly where composability could, in theory, play an important role. But obviously, it is a very complex topic. We have buy-in, and buy-in has certainly accelerated after starting its work, I think it was in 2008, as the industry value network for banking. maybe it was 2.7, but it was about the right frame. But we are still a couple of steps away from a complete solution, a complete set of specifications that could become a standard because of different subverticals of banking, because of APIs that can probably not exactly implement it as designed, and so on and so forth. We also have to keep in mind that I'm still wondering why a vendor should be 100% buy-in compliant if this makes a component completely interchangeable with that one of the competition. But let's move back to architecture. I think what we are discussing right now, when I say we, I mean Don here, Ellen, who is not in this call, and me, we are discussing some kind of layer of the architecture that helps to substitute or to bridge the gap between capabilities, business capabilities that are not composable, which is probably the majority today, and business capabilities that are already composable, that help to bridge the different gaps when it comes to data functionality, to maybe transactional brackets that are quite difficult to implement as soon as we leave the mainframe systems, as we all know. So it's a kind of layer that provides an extremely strong decoupling between different backend systems and different front-end systems. And in addition, it's also about a layer that can provide functional capabilities that embrace a variety of back-end solutions. To use one or two examples, what comes to my mind is, for example, product configuration across multiple cores. This would be in this layer. It could be, say, revenue management, billing, etc., across multiple cores. So these are capabilities that would also ease transformation, as they would put these central functions in a single place while offering strong decoupling when it comes to old and new solutions. So it's really an architectural approach within a concept that we call evolutionary architecture that is meant to support a step-by-step migration, a step-by-step transformation, so that we can support a smooth path toward the changing goals, the changing business goals, the changing business scenarios that a bank typically has today.
What about, God forbid that there is a bank out there that hadn't started any form of digital transformation at all. But let's assume that there might be some, or there are some that started late. What's the kind of hindsight, or what are the common mistakes that you've seen in the last decade or so that they should avoid going forward? Maybe start with Jost this time.
Okay. Obviously, there are plenty of failures in the industry, so that it's difficult to find such a bank. And there are also plenty of operational failures. One failure that I personally like very much is something that happened to me early last year when I suddenly had 100,000 euros minus on my bank account. Believe me, I got a little bit nervous, and it got fixed after one day. The good news story was the call center told me, and by the way, you don't have to pay interest fee for the day. This was very reassuring, but different story. So we have plenty of operational issues, failures in the transformation itself. But what are the general things that made banks basically fail? Interestingly, I believe that many of these things are not so much architecture or technology oriented. These things are more on the bank internal side. It's about mentality, it's about structures, it's about hierarchies. So maybe I can use one or two examples here. I once worked with a bank that basically wanted to go a very defined path towards selecting a new solution. And suddenly they noticed that their management wanted to have results very quickly, a decision for solution X, Y, Z, whatever it was. So they decided very quickly. They took some shortcuts that were pretty dangerous and risky. They sent their recommendation to the top management. The top management waited for, say, a couple of weeks. Maybe it was a couple of months because it was not so urgent. And in an end game, the decision was confirmed, but it was a wrong decision, and the bank had to invest heavily to close the gaps. One thing. So it was about a misunderstanding, to phrase it in a friendly way, between management and project team. Another example is certainly that I've seen quite often is that successful projects will get additional requirements until the best project breaks. So it has happened quite a couple of times. And I guess that we can see this in many geographies and probably in the project history of many vendors. And frankly, there's no vendor I'm aware of that has no failure in his portfolio, to phrase it mildly. Then we certainly also see other topics like I already mentioned risk-averse executives that want to push away the risk. We're also seeing executives that trust vendor promises too much. I remember
that never happens.
Yeah. It happens in real life, unfortunately, as we all know. And to some extent, it works in reality. And to some extent, it will not work. I've seen a couple of cases where these promises did not work in reality. To some extent, they were discovered before contract signature. To some extent, they were discovered before contract signature. So it's always about, I guess, scrutiny. What is real when it comes to vendor promises, to promised capabilities, to timelines, to the plausibility of a given roadmap, to the confidence the bank can have when it comes to a given roadmap. I certainly have seen banks investing in a certain solution, entirely trusting a strategy and a roadmap of a given vendor. I've also seen, to be fair, a handful of banks being successful with such a kind of trustful approach, but it's nothing that would me make sleep very well during too many nights.
Don, what about you? What's your thoughts on that?
I'll give you three. There's many more, but let me just kind of add on to what Jost was just talking about, trust. This is a different type of trust. I call this one honeymoon trust. It's when you start a project in the very beginnings, everybody's happy that the deal's signed, and everybody's kind of afraid to cast any kind of negative tone on the working relationship. So there's too much trust given in the very beginnings without any kind of verification. So I think that's probably one that's a little bit different than what Jost described, but what I say is a big problem. Another one's what I call core cloning. And that's this whole kind of resistance to change that often results in cloning the old system into a new system, which is insane. The last one is probably the most important in my mind, and that is all about data management or the lack of it. It's been a big part of the failures I've seen over the last, probably 30 years, where you have functional data overlap, you have integration issues, known and unknown. And sometimes, as Jost was kind of alluding to, some of these changes that come along were based on just nobody knew that capability was out there to begin with. So I'll stop with that. But believe me, there's a whole lot more to rant on.
I sort of feel we say this so often, but we could literally spend all day talking this stuff through. But unfortunately, we're running short on time.
Nevertheless, let me add one more example, because
there we go.
Triggered one thing in me. I once experienced a situation where a bank wanted to move away from an existing legacy core to an off-the-shelf core. Interestingly, it moved along the lines of core cloning, exactly like you described, Don. What happened was they came up with a huge amount of custom requirements that made the entire cost savings obsolete. And then what they did was quite reasonable. They came up and told the business, hey, if you really want to do this like this, it's exactly the same sequence like you have done it the last 20 years, as opposed to a slightly changed sequence, you need to have a business case. Yeah. And I think this is a sensible way to avoid it. At the same point in time, if you have these kind of strange management structures where there's no clear commitment, where there's no clear vision where a bank would like to be, should be in a couple of years, it's quite difficult to enforce such a kind of business case oriented approach, because the business would say, if we don't have it, we will not be successful. To enforce business cases is not too easy.
Very interesting. I guess one of the things I've observed over the years is just how long transformation takes. And you alluded to it in terms of the CIO tenure and things. But one of the things I wonder is, just in terms of your experience, do you think transformation has been kind of dealt with psychologically in an understanding this stuff is really hard and will take time? And I guess I was kind of keen to get your views on that. But then as 2024, 2025 feels like a kind of almost different moment in time with some of the things that are going on. So what are some of the things that you think banks should be doing to kind of reset their transformation strategy now? So yeah, kind of two questions, I guess.
So this is a huge topic, but if I boil this down into a couple different areas, one of the things that obviously you have to start thinking about is probably the inconsistent regulatory issues that you'll have to contend with. This is going to obviously be much more of a impact on two really segments. First, obviously the tech service providers, and the other is those that have more of a multi-entity approach to their markets. So, whether you have 13 different locations within Europe. So those kinds of changes, I think, are going to require a little more due diligence and attention to make sure that, that you haven't overlooked anything. I think apart from that, let me give this to Jost because I know we're getting short on time, but I think that the biggest issue for me is, I think this goes hand in hand with the composability issue, is really breaking things down into a practical order of things. And again, regulatory issues may play a role in helping trying to fashion or mold how you present something to the market from a tech service provider perspective to make it easier to deploy.
And obviously, when it comes to regulation, it's also about finding the right approach to implement regulation. One idea would be to go for some kind of regulatory platform that allows to cope with new regulation in a much easier way, as opposed to individual software bits and pieces that cope with just this kind of rule and or that kind of rule. It's kind again of a mindset change, but I think it would be pretty beneficial for many banks. At the same time, it's also important not to go for the best possible solution, which means the most complex one, because it will create cost and it will certainly need time. One example that comes to my mind was a bank with a certain implementation project in the investment banking space, and they wanted to go for such a complex set of rules that needed such a complex set of integrations across the different systems of different generations of technology, obviously, that they were so delayed that they needed an extension from the regulator to stay in business, which is obviously not a very beneficial thing. So it's really about assuming or judging very clearly what can be accomplished, as opposed to what would a bank like to have when it comes to regulatory compliance. This is one thing. The other thing, talking about reset, is certainly about planning approaches that are not set in stone. We are all talking about agile and MVPs and you name it. But at the same point in time, I'm seeing many banks saying, from year 1 to year 2, we are replacing system X. From year 3 to year 5, we are replacing core, whatever. And they do it in a very, very detailed way. So every description costs weeks and months of planning at the detailed level. And to some extent, this is necessary, but not always at the very beginning of a project for the entire length of a 6 or 7 year project. So what is quite reasonable is to plan in a very flexible way to differentiate between what a bank would like to have, between what they need initially, and then to do the very detailed planning only early on. Because otherwise, the business situation may change, the priorities of the solutions that will need to come into play will change as well, and then they have to throw away the entire planning for nothing because they have to integrate a new system in the landscape. This is one thing. So it's about some kind of more agile planning with different levels of detail, with different levels of, let's say, different levels of probability to ensure that planning aligns with changing markets. The other thing is something I already mentioned. It's certainly about planning for a transformational architecture that helps bringing together different building blocks, different technologies, in some kind of way that is more evolutionary, as opposed to switching on a new core during a couple of days, so that we can support a transformation that will never end. Because I believe this is certainly the situation we are facing today, that many banks face today, and also a transformation that is probably, that we should not call digital anymore, because digital has become part of the business. So it's basically a transformation of the banking capabilities to allow a bank to most flexibly support new business requirements, regulation, and whatever the bank needs.
Fantastic,
Amazing.
guys. Thank you so much. You've given us plenty to think about, and actually some very pragmatic and practical advice, as you usually always do provide. So thank you very much for coming on to the show. We haven't actually covered my favorite topic, which is about what's going to happen in the future. So we're going to have you back on the show. And also my other favorite topic, which is about AI, which Dave also likes. So we're going to have you back on the show. But in the meantime, thank you so much for your insights on digital transformation.
And when we do meet again, I'd love to know how we make the angry rabbit happy. So that's... But thank you so much. What a great conversation.
Thank you.
Thank you.
Thank you for tuning in to Dave and Dharm Demystify. We hope you enjoyed the show. Don't forget to like and subscribe and tune in next time as we take another topic and demystify it.